Why do 90% of traders lose money, even when they know the strategy? The answer isn't the chart. It's the mind behind the chart. New market participants routinely fall for a specific illusion. They assume success requires finding the perfect technical indicator or memorizing a flawless price action pattern that will guarantee a profitable outcome. When that flawless pattern inevitably fails, a predictable cycle begins. A trader identifies a setup, commits capital, and watches the trade hit their stop loss. The immediate reaction is intense frustration, followed by deep self-doubt regarding their intelligence and strategy. Opening a brokerage account and reading a technical analysis book takes only a few hours. The true barrier to entry is psychological. Joining the 10% of consistently profitable traders requires completely rewiring how the human brain processes certainty. Through millions of years of evolution, the human brain developed a desperate need to seek certainty and avoid physical pain. In the wild, avoiding unknowns kept us alive. In the financial markets, that exact same biological imperative works against us. A sudden financial drawdown registers in the brain's amygdala, much like a physical threat. Rational analysis immediately shuts down, replaced by a fight-or-flight response that forces the trader into rapid, impulsive reactions. This diagram shows the biological responses dismantling trading accounts: fear, greed, hope, and overconfidence. Consider a revenge trade. After a loss, fear triggers an urgent need to recover capital. Driven by blind hope, the trader forces a poor entry, abandoning all rules. The math is unforgiving. Operating in a randomized environment based on raw survival instinct ensures long-term capital depletion. The uncompromising rule of financial speculation is that every single trade is a completely independent event. Our brains naturally look for sequences. If a moving average crossover worked 3 times on Tuesday, we assume it works on the 4th attempt. We incorrectly link past outcomes to the future. This probability tree shows that even after 5 consecutive heads, the odds of the 6th flip remain 50-50. The same logic applies to Forex charts. A streak of losing trades does not invalidate your next entry. The market has no memory of your last position. Neutralizing destructive emotions requires accepting this absolute uncertainty. Once you internalize that the outcome of the next trade is completely unknown, the anxiety of trying to predict it simply disappears. The top tier of market participants share a singular operational mindset. They abandon the attempt to predict the future and instead always manage risk with the mathematical precision of a casino. A casino operates without knowing the outcome of any individual roulette spin. Their mathematical edge guarantees profitability over a sample size of thousands of spins. This grid visualizes 10 trades using a 60% win rate strategy. The sequence of 4 losses and 6 wins is completely random. You might experience 3 consecutive losses. By enforcing a strict risk-to-reward ratio, the 6 positive trades will outpace the negative ones. Consistent profitability never comes from guessing the next candlestick. It comes from ruthlessly exploiting a statistical edge over a large enough sample size. Amateur trading is chaotic, driven by the adrenaline of gambling on rapid price movements. Professional trading is methodical, repetitive, and ultimately quite boring. Professionals operate on a framework of process over outcome. They evaluate their daily performance based entirely on whether they flawlessly executed their trading plan, completely ignoring the financial result of any single position. Judging your ability based on a single financial outcome is toxic to long-term success. Making a profit from a reckless, impulsive decision reinforces bad habits, building dangerous overconfidence. Taking a loss on a perfectly executed setup builds paralyzing fear, causing you to hesitate on the next valid signal. Financial consistency is the direct byproduct of psychological consistency. When the daily process becomes automatic and detached from emotion, the account balance begins to reflect that internal stability. Building this level of mental discipline requires establishing non-negotiable rules. A defined trading plan must be written down, and risk management must always take priority over any attempt to forecast price direction. This requires maintaining a meticulous daily journal. You are recording your emotional state, identifying biological triggers, and documenting your exact thought process before every entry. The fastest way to build this probabilistic framework is to remove the pressure of absolute certainty. Trade on a demo account. Prove to yourself that the underlying math works before you risk real capital. You will never be able to control the market. You can only control yourself. Build your discipline, stick to the process,